Greetings, everyone. We continue with our discussion of current conditions. My students are always curious after getting to this point in the course concerning the inflation they've experienced, especially in the last 3 years, and what caused it and what didn't. So we'll take a look at that here. Also concerning the high inflation in college tuition costs, which also has several drivers, but mainly one driver. Let's look at that first. First of all, these are oversimplified looks, considering the vast number of factors and dynamics would be an entire course. So it's better viewed as a discussion starter rather than a comprehensive presentation. Let me share my screen here. As you can see, the average annual tuition and fees at public four-year institutions has gone up tremendously since 1970. This graph shows you in current dollars what's happened to the cost of college tuition. And this line shows you adjusted in 2023 dollars what's happened to the cost of college tuition. So what happened here? The availability of government-sponsored student loan debt began in earnest in the 1980s. Its immediate effect was to increase demand for college, and as you might expect, knowing what you do about markets, two things are likely to happen. First, colleges and universities reacted by competing for the great inflow of tuition dollars. They increased their size and capacity, and since the flow of money was substantial, they also began increasing tuition every year. This didn't seem to reduce the demand, and so the price increases kept coming and continued at well above the general inflation rate. As we saw before, student loan debt is now at an all-time high, so while the free flow of education funds did promote expansion by colleges, it also caused a higher than natural inflation rate. So how about consumer prices? Let's look at the consumer price index. So here's the consumer price index. As we see, it increases over time rather steadily as the economy expands. Something happened here in late 2020. So as you can see, and as we know, 2019 and early 2020 showed the decrease in economic activity as a result of the COVID pandemic. In general, the Fed considers a 2% inflation rate to be an acceptable target and normally tries to tweak policy to accomplish that. The trouble usually comes when the Fed overreacts and tries to effect a big change in a short time frame. Sometimes that might be justified, like in overcoming the mortgage crisis and financial collapse of 2007 to 2009. Still kind of recovering from that one, as I'll show you in a minute. Sometimes, though, the Fed overreacts when it probably shouldn't. In recent years, it appears that was the case in the reaction to the COVID pandemic, and we can see the result in the Consumer Price Index, where the trend line became very steep compared to the historical trend. And then in 2023, a change occurred, we'll talk about, back to fairly close to the historical trend line slope. So something occurred at the end of 2022 as well. Our last date available here is October 2024, so not quite current, but this is fairly current. This is from the Federal Reserve data. Okay, so the Federal Reserve's response to the shutdown of the U.S. economy during the COVID pandemic was actually very similar to the activities it pursued during the 2007 to 2009 financial crisis. Each of these programs was intended to drive down long-term interest rates to stimulate economic activity and therefore support recovery in the aftermath of the COVID-induced financial crisis. It amazes me the vast number of people who think that COVID caused inflation. This is a narrative that has been promoted by those whose actions did cause it, and it's been promoted and amplified by the media. The actual cause was very similar to what has caused high inflation in the past: overstimulation of the economy by politicians and by the Federal Reserve. That's exactly what happened in response to the COVID pandemic and the shutting down of massive parts of the economy in 2019-2020. The actual pandemic and forced shutdown actually had a deflationary effect, not inflationary. Initially, the stimulation was undertaken to combat the economic stagnation from the shutdown. Politicians and policymakers just went way too far. So how did the Fed ease monetary policy in 2020? One, the federal funds rate. In response to economic pressures, the Federal Reserve lowered its target for federal funds by 1.5 percentage points. This was during meetings on March 3rd and March 15th in 2020, just before the depth of the pandemic-caused recession. This made covering reserve ratios almost costless for banks, very stimulative. The federal funds rate affects other short-term interest rates and therefore influences long-term rates. This move was really designed to stimulate spending by making borrowing cheaper for both households and for businesses. Second thing the Fed did was to use forward guidance. Again, this was a tool developed during the 2007 to 2009 financial crisis. Initially, the Fed indicated that interest rates would remain near zero until the economy had recovered and was on track to meet its goals of full employment and price stability. In September 2020, though, the Fed changed that guidance to reflect its new monetary policy framework. The Fed stated that rates would stay low, quote, until labor market conditions have reached levels consistent with the committee's assessments of maximum employment and inflation has risen to 2% and it's projected to moderately exceed 2% for some time. That's a very wordy way of saying we're going to continue this easy money for quite a while. At the same time, the Fed was pursuing quantitative easing. The Fed resumed its large-scale purchases of debt securities, a strategy it had used also during the 2007-2009 recession. And on March 15, 2020, right before the depths of COVID, the Fed refocused quantitative easing on supporting the economy, committing to buy, at minimum, a whopping $500 billion in Treasury securities and $200 billion in government-backed mortgage securities. On March 23rd, 8 days later, it made those purchases open-ended, pledging to buy as much as needed to, quote, ensure smooth market functioning and enhance the transmission of monetary policy to broader financial conditions. By June 2020, the Fed set its pace at a minimum of $80 billion per month in Treasury purchases and $40 billion in residential and commercial mortgage-backed securities. By December 2020, it signaled that it would slow those purchases once the economy had made substantial further progress toward its employment and inflation goals. About a year later, by November 2021, when the economy had met those criteria, the Fed began tapering purchases, still purchasing, but tapering purchases by $10 billion in treasuries and $5 billion in mortgage-backed securities each month. And then, at the FOMC meeting in December 2021, the pace of tapering accelerated, with the Fed reducing its bond purchases by $20 billion in treasuries and $10 billion in mortgage-backed securities per month. Simultaneously, the federal government instituted stimulative direct checks to the public of more than 476 million checks, totaling $814 billion in financial relief. The Internal Revenue Service bases the amounts that individuals received on income, tax filing status, and number of children, or qualifying dependents, like a relative. So how much was paid in each of the three rounds? Round 1, which occurred at the depths of COVID in March 2020, was $1,200 per income tax filer, plus $500 per child. This was called the CARES Act, C-A-R-E-S Act. Round 2 occurred in December 2020 of $600 per income tax filer, plus $600 per child. This was called the Consolidated Appropriations Act of 2021. Round 3 occurred in March 2021, a year after the depths of the COVID pandemic, which sent checks out another $1,400 per income tax filer, plus $1,400 per child. This was called the American Rescue Plan Act. Bear in mind that Round 3 was certainly into the recovery of the economy, and even the December 2020 checks that were sent out might have been questionable in terms of their wisdom. So there may have been justification for Round 1, which occurred after the depth of the coronavirus shutdown recession in March 2020. But by December 2020, the economy had not only recovered, but was showing early signs of overheating. The checks sent out in December 2020, while Trump was still president, was fairly effective at stimulating spending, In March 2021, well after Biden had become president, well, those checks were probably inadvisable at best, considering the Fed's continued securities purchases and lack of interest rate hikes in response to rapidly rising inflationary pressures. Well, by the end of 2021, inflation had far surpassed the 2% target, and the labor market had reached maximum employment. At the December 2021 meeting of the Federal Open Market Committee, it was indicated that most members expected to raise interest rates 3 times by a quarter percentage point in 2022. But an already overstimulated economy was still receiving monetary stimulus from low rates and quantitative easing at that point, and federal spending packages from the new administration and their party's majority in the House of Representatives and their effective control of the Senate as well, that they only had 48 Democratic senators, but there were 2 independents who consistently caucused with Democrats, and that's a 50-50 vote. So in a 50-50 split, you probably know this already, the deciding vote is cast by the vice president, who at the time was Vice President Harris, serving as the tiebreaker in her constitutional role as president of the Senate. So Democrats effectively gained control of the Senate and thereby trifecta control of Congress for the first time since the 111th Congress ended in 2011. That fast-tracked Democratic spending, and spend they did, increasing the overstimulus of the economy. The result, as you might expect from your study of the financial system this semester, was a 2-year period of runaway inflation. But political conditions actually changed in the midterm elections in 2022. It's about here, November 2022. And the Democrats' supermajority dissolved. That made it difficult to force through spending packages, and simultaneously, and under great criticism for the runaway inflation, the Fed slammed on the brakes too, with restrictive monetary policy. So we have several sectors that are stalled out now, like new mortgages, and this is having a suppressive effect on prices in general. Still some price pressure upward from some sources, but it appears that there may be support for a more reasonable economic policy now. We shall see. We have a new administration taking office in January, and serious issues facing the country in the future. One can hope, but I know most of you aren't counting on politicians to solve much. Again, as complex as this discussion could be, this video just skims the surface. I would encourage you, with your background from Finance 3310, to filter all the rhetoric you might hear, especially that promoted by the media. These are the times we live in. As we said in the initial Zoom meetings of this semester, we do live in interesting times. That Chinese curse is upon us. Y'all take care. It's been a pleasure pushing the bounds of knowledge with you this semester. Oh, oops, there was one more thing I wanted to show you. And that's what happens to the Fed's balance sheet as it does this quantitative easing stuff. Let me try to share the screen again. So here is a chart of the Fed's balance sheet since 2007. Some interesting things here. You see 2007, and then in 2008 we had a jump upward. This was QE1 in response to the 07-08 recession. And as you see, the Fed continued making those securities purchases. And those assets stayed on the books until about 2018 when they started unloading some of them. But then what happened in 2019? Suddenly the Fed starts buying again. So this jump up right here, that indicates the Fed's first reaction to the COVID pandemic and continued purchases of mortgage-backed securities and government securities until 2022, and then it began tapering. So we're here, the last date here is October 2024. It's a little bit lower now, but as you can see, Fed purchases never actually recovered from the 2007 to 2009 purchases. It went down a little bit, but then COVID happened. This indicates really unprecedented quantitative easing from the Federal Reserve. And again, maybe we'll see some policies change. Maybe the Fed will unload some of these asset positions and adopt a little more reasonable economic policy going forward. So that's what I wanted to show you. Forgot all about that. Sorry about that. So I'm going to sign off now. So have a great end to your semester and also have a great winter break.